In this video, you are going to watch real charts where price spent days coiling inside a tight range, then broke out and ran hard. One of those setups caught nearly 10 hours of profit by simply trailing the trend. And one of the later examples breaks out in the direction most traders never see coming. Before we look at the charts, here's the idea. It comes from Richard Wyckoff's work. Big players can't buy or sell size all at once without moving price against themselves, so they work slowly inside a range that looks like boring sideways chop. That's the point. Retail loses interest, volume dries up, and a position gets built. Here's what most people miss. The liquidity isn't inside the range, it's just beyond it. Stop losses from traders fading the range sit above the high and below the low, and pending orders from traders waiting for confirmation sit right there too. Once accumulation is done, price pushes through that boundary and takes all of it at once. Those fills are the fuel that lets the move travel. When price holds outside the range instead of snapping back, that's the tell. Accumulation is over. Markup has begun. Sometimes the final shakeout comes first. That's called a spring. But today's charts show the cleaner version. Break and go. The first chart is ETH against USDT on the 4-hour time frame. All times here are UTC. The accumulation range began on January 29th, 2024 at 1600 and it ran all the way to February 7th at 1200. That is over 9 days of sideways price action. The range high was $2,392.91 and the range low was $2,239. You can see price chopping back and forth inside that box, compressing, building tension. Nothing about it looks exciting from the outside. Then on February 7th at 1600, the sweep arrives. Price pushes up through the range high and tags $2,425.80. That is not a random wick. It is collecting the stop losses from every trader who shorted the range high. And the push through that level also triggers the resting buy orders sitting above it, feeding the move. 4 hours later, at 2000 on the same day, the entry triggers at $2,421.27, with a stop loss set at $2,348.74. The risk is defined, the range is behind us, and the markup trend is beginning. There is no fixed target on this setup. The idea is to let the trend breathe and trail the stop behind it rather than cutting the trade short at an arbitrary level. Pull back now and look at what happened over the following 3 weeks. By February 28th at 1600, the trailing stop finally catches price and the position exits. The trade returned 9.627 R. That is what a clean accumulation structure, a decisive sweep, and a trailed markup can produce on a single setup. The second chart is also ETH against USDT, also on the 4-hour time frame, but this one is from over a year later. The accumulation range opened on June 24th, 2025 at midnight UTC and ran to July 9th at 0800. That is 15 days of compression. The range high was $2,647.69. The range low was $2,372.67. It is a wider range than the first example, but the structure is the same. Then on July 9th at 1200, the sweep fires. Price pushes above the range high and reaches $2,674.90. The stop losses above the range get collected, the weak longs who bought early get shaken out, and the operator who built the position through the entire consolidation now has the liquidity needed to push price with force. 4 hours later, at 1600 on July 9th, the entry triggers at $2,658.19, with a stop loss at $2,560.43. Same rule as before. No fixed target, trail the stop and let it run. The trailing stop catches price on July 23rd at 1600, closing the trade at 9.288 R. 2 setups, 2 assets, different time periods, both running the same playbook. Accumulation, sweep, breakout, markup. The chart does not lie about the structure when you know what you are looking at. Now here is where it gets interesting because the third chart is BTC against USDT 4-hour time frame and this setup goes short. That is the one I hinted at in the opening. Most people who learn accumulation and breakout instinctively think upward. But the same process happens in reverse, and it is just as clean when it does. The range on this chart formed from January 20th, 2026 at 1600 UTC to January 29th at 0800. That is just over 8 days. The range high was $91,222. The range low was $86,090. Price spent those 8 days coiling between those two levels. In Wyckoff terms, a range like this is distribution, the mirror image of accumulation. Sellers absorb the demand and smart money builds short exposure. Then on January 29th at 1200, the sweep happens below the range low. Price drops to $84,389.90, sweeping the buy stops sitting under that low and shaking out any longs who had stop losses there. 4 hours later at 1600 on the same day, the short entry triggers at $84,908.52. The stop loss sits at $87,990.31, above the range body where a reclaim would invalidate the setup. Same rule as before, no fixed target, trail the stop and let it run. What follows isn't markup, it's markdown. Same engine, pointed down. The trailing stop exits the position on February 6, 2026 at 1200, and the trade closes at 5.089 hour. 3 different setups, 3 clean outcomes, and the same underlying process driving all of them. 3 charts, 3 clean examples of the same idea. ETH built a range and broke up into a 9.6 hour trend. ETH did it again a year later for over 9 hour. And then BTC flipped the script, swept below its range, and broke down for over 5 hours to the short side. Accumulation, sweep, breakout, markup. That sequence does not care about direction. It happens in both. If you want to see more real setup breakdowns like these, subscribe. There is more coming.